Welcome back to our economy-focused channel. Today, we are delving into a fundamental concept that plays a pivotal role in decision-making for individuals and businesses alike: the intriguing world of opportunity costs. In this video, we'll explore what exactly opportunity costs are, why they matter in the world of business, different types of opportunity costs, and even dive into some real-life examples to help illustrate their significance. So whether you're a budding entrepreneur seeking to make wise choices or simply curious about the hidden trade-offs we encounter daily, stick around as we unravel the mysteries of opportunity costs and their impact on the business landscape. But first, let's start with the basics. What exactly are opportunity costs and how do they shape our decisions? Let's find out. What is opportunity cost? Opportunity cost is the value a company gives up when it chooses one option over another. This can involve financial losses or the loss of time and energy. When a company allocates resources to one activity, it means it's not pursuing a competing activity. Opportunity cost is especially important for smaller businesses with limited resources and funds. They must weigh their decisions based on potential returns and risks to make better choices. Opportunity cost explained. Opportunity cost arises when a business selects one option over another. Let's take the example of an e-commerce company that has been shipping its products directly to customers. As the sales volume increases significantly, the time required to manage shipping becomes overwhelming. Consequently, the company is now contemplating outsourcing this function to a third-party logistics provider. Although this alternative might be more expensive, the time saved holds value by reducing employee involvement. This enables the workforce to concentrate on developing new products, which, in the long term, can result in generating additional revenue streams. How to calculate opportunity cost. Opportunity cost is an integral part of the cost-benefit analysis process used by businesses to make decisions. It involves comparing the potential returns of the option not chosen with the returns of the option selected. Gathering the necessary inputs for the analysis may be time-consuming, but the calculation itself is straightforward. Opportunity cost equals sign. Return on option not chosen. Return on option chosen. For example, if a growing e-commerce business must choose between leasing a nearby warehouse for $6,000 per month or a similar facility 20 miles away for $5,000 per month, selecting the more expensive option incurs an opportunity cost of $1,000 per month. Additionally, other costs like commuting time, gasoline, and vehicle wear and tear should also be considered, making the seemingly pricier decision potentially less expensive in the long run. What opportunity cost tells businesses? Every business decision involves comparing the benefits gained and lost. The opportunity cost refers to what a business gives up by not choosing a specific option. For example, if a business decides to purchase a new construction vehicle, it must weigh the benefits of having it, like starting a new project while another is ongoing, against the costs of not having it, such as missing out on the opportunity and profit potential of that new project. Understanding the opportunity cost helps the business evaluate the implications of its choices and the opportunities it may gain or miss out on. What opportunity cost tells individual and investors? Opportunity costs play a crucial role in decision-making for individuals and investors. These costs represent the potential benefits foregone when opting for one alternative instead of another. The concept applies to a wide range of scenarios, from everyday choices made by individuals to significant investment decisions made by businesses and investors. For individuals, opportunity costs can manifest in various aspects of life. Consider a young professional deciding between two job offers. One offer provides a higher salary, but the other offers more flexible working hours and a shorter commute. If the individual chooses the higher-paying job, the opportunity cost would be the improved work-life balance and reduced commuting time they would have enjoyed with the other offer. These unseen benefits may not be immediately apparent, leading them to overlook the potential trade-offs. Similarly, individuals face opportunity costs in their personal finances. For instance, when choosing to spend money on a luxurious vacation, they might overlook the opportunity cost of saving that money and investing it for long-term financial growth. These missed investment returns could substantially impact their future wealth. Opportunity costs can be especially challenging to recognize and quantify for investors because they often involve uncertain and unpredictable outcomes. Nevertheless, considering opportunity costs is essential for making informed, strategic investment choices. By carefully weighing the potential gains and losses of each investment opportunity, investors can strive to optimize their portfolios and achieve their financial goals. Types of opportunity cost. Opportunity cost can be categorized into two types: explicit and implicit. Explicit costs. Explicit costs are also known as accounting costs or explicit expenses. These costs are easily quantifiable and recorded in a company's financial records. They include tangible expenses that directly impact cash flow and profitability. Examples of explicit costs are rent, payroll, equipment purchases, utilities, and advertising. Implicit costs. Implicit costs are more challenging to measure since they don't have a specific monetary value that can be easily tracked. These costs represent the indirect and intangible expenses incurred by using existing assets and resources. Implicit costs, also referred to as implied, imputed, or notional costs, are not recorded in financial statements and don't contribute to reported profits. An example of an implicit cost would be the time spent by an employee on research, which represents a lost opportunity to work on other productive tasks. Opportunity cost and profits. Opportunity cost can be seen as the profit gained or foregone due to a business decision. There are two types of profit: accounting profit and economic profit. Accounting profit. Accounting profit is the net income of a business, often referred to as the bottom line, as it appears at the end of the income statement. To calculate accounting profit, total explicit costs are subtracted from total revenue, giving insight into the company's financial performance. This figure is essential for investors and lenders as they evaluate whether to engage with the business. Economic profit. Economic profit is determined by subtracting both explicit and implicit costs from total revenue. It may significantly differ from accounting profit because it considers opportunity costs, representing the value of the alternative actions not pursued. Economic profit offers an assessment of how efficiently a business allocates its resources and operates in light of the opportunity costs involved. It provides a more comprehensive picture of the business's overall performance. Opportunity cost examples. Examples of opportunity cost abound in various decision-making scenarios. Here are some instances. Company product launch. A company invests $50,000 to launch a new product. The opportunity cost in this case is the value of that $50,000, which could have been spent elsewhere on different projects or investments. Employee education decision. An employee contemplates pursuing a full-time master's degree. The opportunity cost here is the salary the employee will forego for the 2 years spent on education. Stock investment dilemma. An investor is torn between selling $8,000 worth of shares in a company now or waiting for 3 months when the stock price is expected to increase. The opportunity cost in this example can only be determined after 3 months when the difference between the current stock price and the new stock price is calculated. Inventory management. A company faces the decision of whether to discount a hot-selling product by 15% to clear inventory. By doing so, it forgoes $1,500 worth of revenue, but saves on annual carrying costs, which amount to $2,000 or 20% of the product's value. Business investment options. A business has $500,000 surplus and must decide between upgrading its manufacturing plant or investing in the stock market. If the renovations are expected to generate a 9% return in the first year, and the investment in stocks is projected to yield 12% during the same period, the opportunity cost of choosing the first option is 3%. Investing in stocks would be the more favorable choice since the return is expected to be higher. In each of these examples, there is a value associated with the alternative option not chosen, illustrating the concept of opportunity cost in decision-making processes. Calculate opportunity cost with accounting software. Opportunity cost is a critical aspect of decision-making for business leaders, as it represents the value of the foregone alternative choices. To calculate opportunity cost effectively, access to real-time transactional and financial data is essential. Comprehensive software solutions like NetSuite cloud accounting software can streamline this process by providing quick access to the needed information. The cloud-based platform facilitates data collection, allowing decision-makers to estimate returns for various scenarios efficiently. NetSuite's accounting software offers businesses a holistic view of their cash flow and financial performance. It automates time-consuming accounting tasks, such as updating journal entries, account reconciliations, accounts payable and receivable processing, and closing the books. As a business grows, it becomes necessary to manage other operational activities, like supply chain, inventory, and order management, efficiently. NetSuite ERP integrates these functionalities into a single database, providing a comprehensive view that leads to more informed decision-making and positively impacts profitability. Informed decision-making is crucial for successful businesses, and they rely on data to allocate their finite resources, such as capital, time, and energy. By factoring in opportunity cost, which encompasses both implicit and explicit costs, businesses can determine the most profitable path to achieve higher returns and greater overall profitability. And that wraps up our exploration of opportunity costs and their profound implications for businesses. We hope you found this video insightful and that it shed light on the often overlooked aspect of decision-making in the world of entrepreneurship. Remember, opportunity costs are not just an economic concept. They are a way of thinking about trade-offs in all aspects of life. Understanding the potential benefits we forego when making choices is crucial for making well-informed decisions, both in our personal lives and in the business realm. Before we say goodbye, we'd like to hear from you. Do you have any experiences or questions related to opportunity costs? Share your thoughts in the comments below, and let's continue the conversation. If you enjoyed this video and found it valuable, don't forget to give it a thumbs up and consider subscribing to my YouTube channel for more engaging content on economics, business strategies, and much more. Take care and see you in the next video.